This is Alan Bush with ADMIS with the daily financial forecast for Tuesday, January 26th. Starting out with the stock index futures, we are seeing prices higher this morning, in fact quite a bit higher. This is rather amazing in the sense the Chinese equity markets fell very sharply last night. In fact, the Shanghai Composite Index was down over 6%. So it looks like we are getting away from the relationship of what is happening in the Chinese equity markets to what happens here in the U.S. with North American equities. And in fact, it looks like traders are now focusing less on what happens in China and their equities market, and they are now looking primarily at the energy markets, which have gained today. So crude oil firmer, and that in turn is helping stock indices to advance. Also, we had the Consumer Confidence Index this morning coming in better than expected, so that also supportive. And we do feel that once the energy markets settle down, then the markets will be left with the ongoing influence of the globally low interest rate environment, which will ultimately rescue this stock index futures market. Now, moving over to the currencies, very little news overnight that would affect currencies. The dollar index was a little bit higher earlier, now a little bit lower. No major economic reports other than the Consumer Confidence Index, which was somewhat supportive to the dollar index. Also seeing the commodity currencies, the Canadian and the Australian trading a little bit higher. This directly linked to the energy prices that are firming now. Longer term, though, we do feel that the dollar index will continue to advance through this quarter, which is also in conjunction with the seasonal indications. Now, moving over to the interest rate futures markets, we're seeing a rather steady trade. One thing that we have noted that as of late, the probabilities of a rate increase from the Fed have been dramatically curtailed. It now looks like at the March meeting, there's only a 32% chance that the Fed will raise at that meeting by 25 basis points. If you recall, it was in the first week of January, in fact, January 6th, that the probability was as high as 55%. Also at the July meeting, the probability of a rate increase is now at 54%. So the probability of a rate increase from the Fed is very much now moved out into the future. If you recall, most analysts were looking for 3 rate increases this year. The Fed was talking about 4. It looks like there's going to be much less than that, maybe only 1 or 2. So in spite of that, though, which would be considered friendly for the interest rate futures markets, we are a little bit negative at the long end. We do feel that core consumer inflation prices are advancing, and I think that will ultimately dominate, and I think that is likely to be the influence that pressures the long end of the curve, the 30-year bonds. So even though we are in overbought territory here into 30-year bonds, I think the pressure is likely for that issue. So once again, good trading, everyone. And once again, remember, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.